There have been a lot of developments in the economy, real estate, and housing in the past several months. What can we expect in the market coming up? Is real estate going to be flat, go further negative, or perhaps be inflated into another bubble? Since our last video at the end of last year, a great deal has happened, so in today's video, we're going to dive into the issues that we think will drive the market for the remainder of 2024 and into 2025. Let's get into it.
Time has come for policy to adjust. The direction of travel is clear.
It has now surpassed $35 trillion. It hit that number for the first time on Monday, and
the Bank of Canada has moved forward with another interest rate cut. That trend giving the central bank the confidence to cut its key rate for the third time in a row.
The Liberals now open to reducing the number of permanent residents admitted to Canada every year.
The latest monthly numbers show fewer housing starts than 6 years ago, and experts anticipate the slowdown to continue.
There is more evidence tonight of Toronto's stalled condo market.
Some analysts say it's the worst it's been in 30 years.
Listings show it sold for $1.23 million, down about 21% since the purchase in 2021 for $1.55 million. That's about a $320,000 loss.
Thanks for watching. This is Andy from Suite Additions. If you're new here, we're an architectural design company helping homeowners and investors create more housing units and generate long-term wealth using the Max Suite strategy. Over the years, we've completed many small-scale infill projects and helped over 400 clients legally convert their homes to multiple units, boosting cash flow and house value. Additionally, we have a comprehensive Max Suite strategy in-person training program and investor community. Our next session is coming up. If you're interested, please check out the details in the description below. Also, it would help us out if you can give us a like and subscribe so we can get this message out to more people. Before we get into the issues at hand, let's have a quick look at where we are in the GTA real estate market. According to TREP data, 4,975 homes were sold in August, 5.3% lower than August of last year. The average selling price was down slightly at 0.8% compared with last year, with the average home in the GTA selling for $1.074 million. So the biggest news, of course, is the trend of interest rates. As customary, we're going to discuss the US first and the broader macro environment. This is because whatever happens in the US, Canada and most of the Western world follows. As a reminder, I'm not an economist, but someone who tries to look at the big picture and make financial decisions for myself. With all the information out there, please take it with a grain of salt. Of course, we are now aware that the US economy has softened significantly with expectations of several rate cuts by the end of the year. The Fed has given clear indication that it plans to start its rate cutting in September. The CPI, Consumer Price Index, slows to below 3% for the first time since March of 2021. We really knew that it was just a matter of time before the high rate environment affected the entire economy to function, in addition to the government themselves. As it currently stands, the US has surpassed $35 trillion in debt, around $2 trillion higher since our last video on this topic back at the end of 2023. At current rates, interest payments alone has surpassed defense spending at close to $1 trillion annually. More scary are the US unfunded liabilities at over $218 trillion. What this all means is that in the coming years, there will likely be lower rates or extreme money printing to monetize the debt levels, or a combination of both. What this actually looks like is the central banks adding more zeros on their balance sheets to purchase US treasuries. This can happen sooner in the coming months, being an election year in the US and bigger spending expected. In the long run, this will likely continue driving asset prices higher, which I personally believe is what they want. They are okay with asset price inflation as it drives more tax revenue, as we saw with real estate and stocks throughout the 2010s. They're just not okay with consumer price inflation, since that looks really bad from a political standpoint. Now that consumer inflation has come down a bit, it will give them an opportunity to lower rates and provide more liquidity in the credit markets, including more lending for real estate, which in my opinion will keep home prices elevated. So how does this relate to Canada and the GTA? Well, really it's the same, but at a smaller scale. The Bank of Canada just lowered its rates to 4.25%, a third consecutive rate cut. With Canada's own consumer inflation lowered to 2.5%, some economists see a rate of 2.75% by the end of 2025. We're also spending like crazy here, and the government is racking up huge amounts of debt. All of those federal funding programs for new housing is really just printed money that will rear its ugly head in inflation down the road. Adjusting for population, things are probably worse for the average individual and family here in Canada, and we'll explain why. We are facing all the same macro headwinds as the US, with high public and private debt levels, long-term inflation, and even worse housing affordability and public services for several reasons. Of course, a lot of it has to do with the huge additional population in the past several years without the housing and infrastructure to support them. Even the recent policy shift to reduce the number of temporary workers and students, the growth in population is still very elevated compared to the past. Additionally, the past 2 years have been extremely challenging for developers of housing. Even with relaxed policies for densification, the rate environment, higher costs for materials and labor, and permit challenges have meant that many projects have been put on hold or scrapped altogether. Single-family homes are hardly being built, so you can expect that if you do own one of these units, that longer term, these will be in greater demand. A few months ago, a report by Ben Rabidel indicated that for every single-family home that has been built in the past year, Canada has added 20 more people to the population. Building permits for these types of homes have hit a 40-year low. What this means is that if you own a low-rise single-family home or are in the plans to purchase, most likely this type of home will be in greater demand in the future. Additionally, you have the ability to force value appreciation to this type of property. Of course, we discuss implementing the max REIT strategy on these properties, and there are location dynamics to mitigate the risk from a broader downturn. Given that sentiment is at a low right now, with interest rate cuts on the horizon, now may be a good time to consider that purchase to get a lower price, greater optionality, and reduced down payment requirements. If you obtain a variable mortgage, it will be higher right now, but may be lower in the coming months and years. Of course, we don't want to be at the whim of the overall market conditions. If you are going to make a purchase, it's best to mitigate your risks as much as possible. And not all real estate is the same, which is why we recommend single-family homes where you can force value increases, even if the overall market goes down. On a single-family home, you can make many improvements to increase the value greater than the amount that you put in. This can be in the form of upgrades to systems and components, cosmetic improvements, increasing curb appeal, and of course, adding in additional suites. Further, you want to focus on some of the location dynamics such as ideal cities and towns, specific neighborhood pockets poised for growth, as well as individual property lot characteristics with the potential for value creation. We covered individual strategies in a past video, which you can check out here. A link is in the description. Basically, we outline 8 strategies you can use to help reduce risk and increase success of your project. This strategy works great whether you're an investor looking to increase value and boost cash flow on the property, or you want to buy a home for yourself and have additional units for family members or for house hacking purposes to help offset costs. By implementing the strategies above, you can help to mitigate downside risk even if there's an overall downturn while maximizing the potential for greater returns. And couple this with reduced single-family home construction, this will likely drive greater demand for these homes in the coming years. You're not really able to force value appreciation with a condo apartment. Now, if you're not interested in doing all of this and just want to buy a small, affordable place for yourself, you can certainly buy a condo, and now may be a good time for that. Much of the condo market is in a severe downturn right now, caused partly by many investors who were forced to sell as they could not sustain mortgage and other expenses in the past couple of years. I feel that this has created a temporary glut of supply in the market, which we're seeing now. After this additional supply is absorbed by the market, and with less condo construction happening, I think there's a strong possibility that there will be a constraint again, even in the condo side of things in the next few years. Of course, if you don't want to take a chance, single-family homes are your best bet in my opinion. And of course, don't get over-leveraged. If you're not already in the market, buying one house and performing upgrades and conversions makes sense, especially if it's for yourself to live in. If you already own property, consider improving those properties before making another purchase to mitigate risk. One big opportunity for great returns that I see are homes with nice detached garages that can be converted. This is perhaps the best return on investment and effort. One other consideration is starting a business in the space of multiple suite conversions. This is a big trend now, of course, and there is a great deal of demand for many professionals in this space, whether you want to be in the design and consulting side of things, contracting and trades, or as a real estate professional. We outlined this in a recent video. You can check that out also in the description below. Additionally, as mentioned earlier, we have a Max Suite Strategy in-person training program and VIP investor community coming up at the end of October, where we cover these strategies in detail with experts in the industry. As part of this, we're also supporting professionals who wish to substantially increase earnings, contribute in this space, and enjoy a rewarding career. If you're interested in participating in our community, please apply at www.suiteeditions.com/training. In conclusion, we feel that in the long run, real estate in Canada will be a good hard asset to be in, as our governments continue to debase our currency and lower the value of our dollar. Homes will likely be a good hedge against long-term inflation we see on the horizon. Additionally, because you're able to leverage using real estate, the return is much greater than the average annual price increase of 7% in the past years. For example, many consider 20% down as a responsible leverage amount. At a 7% annual increase, the total returns on your investment with down payment is actually over 30% annually. Of course, there's no guarantees, but this is what we've seen in the past 20 years roughly. And by actively adding value to a property by implementing the items we discussed earlier, along with identifying excellent locations for properties, you're likely able to perform much better than the average market. So hopefully this was helpful and gave you some more things to think about as it pertains to real estate for the remainder of 2024 and into 2025. Again, please continue to do more research and do what's best for yourself and your family. Best of luck to you, and let me know what your thoughts are on the state of the Canadian real estate market coming up. Thanks for watching, and we'll see you in the next video. To learn more about the Max Suite Strategy, download our free guides at suiteeditions.com and get started. And if you enjoyed this video, here's another great one for you.